10-year note yields had been trending higher with a bit of momentum building above that old 170 to 180 range we'd spent about the last 2+ weeks in, and then we got above 180 for the last 3 sessions. Ahead of the Fed announcement, ahead of any expectations for what the Fed might do or say, and come out maybe a little less dovish than everybody thought. And the Fed did come out a little less dovish, but at the end of the day, they said some things that prompted the market to reverse. We saw equities rally, we saw bonds rally, we saw gold rally, and bonds traded back, and 10-year note yields went back into that old range for the first time since last week. So we got back into that 170 to 180 range. Sort of took a lot of the selling momentum and luster out of the market, something we'd sort of gotten used to, I think, and we're expecting maybe a push towards 190, but it has failed at least today, and we are back inside that old range, waiting now for the next bit of news, which will most likely be the biggest set of news coming up, will be employment on Friday. That's not for another couple of days. Market volatility was also non-existent today post-Fed. Obviously, that's expected when you get to an event, things sell off, so not really much to talk about there. Lower yields, lower vols. What did the Fed say, though? The Fed came out, they cut the overnight rate by 25 basis points, which was expected. They tweaked the language a little bit, though, took out some of the words, some of the phrases that maybe would have kept you hanging on for another cut down the road. I think the Fed really wants to make this very much a data-dependent type of Fed policy. They don't want to be tied to any cuts or anything else, or no cuts. I think they want to be open and free to do what they want. At this point, though, it seems that the market acquiesced when it saw the statement. When it got to the press conference, though, and Mr. Powell said that they would be watching inflation. Any rises in inflation would probably see more rate cuts. That's when the equities took off and bonds took off, because now they had a reason. Now we have something to hang our hat on. Hey, if inflation goes up, they're going to be cutting, no doubt. And it's not necessarily that black and white, but that's certainly the way the market reacted. So we did see yields go down post-Fed. We saw equities rally. And at this point, we're back into that old range. And I'm not sure we're going to head all the way back down to 170, the low end of that range, but we'll certainly probably get closer to 175 than a lot of people would have thought just a few days ago. So yields right now back into the old range. What was the other bit of news today outside of the Fed? Well, if you may have missed it, there was some supply. The refunding announcement came out. No changes from last quarter, but at this point, there is some whisper talk about possibly issuing longer-term bonds, which would throw a wrench into the market. You're looking at 50 or 100-year bonds. It's not the first time that this has been talked about, but certainly is not something that they've put into actual practice here in the States. Likewise, they're talking about a 20-year bond linked to a SOFR rate to help with the repo markets. A lot of that is still in very preliminary discussions. Obviously, the Treasury is looking for ways to ease some of the stresses that we're seeing in the front end. Likewise, with some of the dollar scarcity and bond scarcity that we're seeing, they may want to look to issue different buckets to sort of ease those scarcity issues. And right now, though, nothing has been done. So certainly that didn't adversely affect the market. The announcement of more supply, or as expected supply with potential for longer dated bonds, didn't really have an effect on the market. But certainly as we head into the end of this year and into next year, I would expect the Treasury to continue to talk about that, because these issues aren't going to go away. And more supply for longer dated bonds could certainly have an effect on the current issues at hand. So that aside, we look at Treasury yields heading back into the old range, volatility non-existent, and a Fed that wants to kind of be on hold for a while, but may look to cut again if things in the inflation world don't act good.